It is Friday, July 10th, 2015, here in sunny Scottsdale, Arizona. This is Michael Douville coming to you. Yes, it's very, very hot here in Scottsdale, but everybody forgets how stunningly beautiful it is here. So, don't feel too terribly bad for me. I am here for the summer. Normally, I'm in Australia, as you know, but we're here this summer, so I can answer any questions that you have. I need to get my disclaimer out of the way. I am not a licensed financial advisor nor a licensed stock and bond broker, but I am a licensed real estate broker here in the state of Arizona, and I do principally do an awful lot of investments. I handle people's I have a relationship business with an awful lot of people, so we handle a lot of their portfolio. So we're used to dealing with investment work, so I'm reasonably well versed in stocks, bonds, and other asset classes. So, I don't profess to be a finance professor, but I certainly have a pretty strong working relationship with most of the asset classes, just to the nature of my business, which I've done for a very long time. There's some things that are just going on in the world that you just cannot possibly let go by. Listen to these words. Get out of the stock market. Get out of the bond market. You've made enormous gains. Take the profits. Take half off the marketplace and reduce your risk. How much more do you want it to do for you? When you start seeing these problems and this volatility comes up, it's telling you something is not right. Look what's going on in Greece. Everyone says, "Oh, well, Greece is about the size of New Hampshire. It's got a really small economy. Sure, it's terrible for what's going on there, but it's a precedence for the rest of the euro." Spain is just hanging on. Portugal just hanging on. France, they're up to their eyeballs in debt. The only one that's really, really doing well is Germany, and they're starting to have trouble there themselves. Italy, the sixth largest economy in the world, Italy's having trouble. And they'd love to have a haircut on their bonds, and quite honestly, there's movements in all these countries to get out of the euro and to reduce their debts. And reduce the debts, what they're saying, not reduce their debts. What they're talking about is giving everybody a haircut and defaulting on a lot of these bonds. So get out of the bond market. You're going to see interest rates go up because risk is rising. And look what happened in China. These poor people in Shanghai. Shanghai, I've been talking about that for months now. Shanghai is in a parabolic increase. I said it is in a classic textbook bubble. It burst, and it went from up 135%, and it dropped 30%. And they have their Chinese NASDAQ also in Shanghai, and that went down 40% in 3 weeks. 3 weeks. Now, China is what we need to be concerned about. China has one of the greatest real estate bubbles in the world. We put $3 trillion into our economy. Everybody says, "Oh, well, the Fed expanded their debts by $3 trillion. The Chinese put $27 trillion. $27 trillion. They affected all these commodities around the world. I go to Australia all the time, and the Australians were gloating for the fact that, well, iron ore went from $44 a ton to $190 a ton. Well, God, how cool is that? But you know what? Now it's down to $40 a ton, and everybody ramped up, and now they're having problems because of that, because you see commodities. That's what's happening with oil. There's no demand. You don't say, "Oh, there's so much supply." No, it's not the supply. It's demand. Nobody wants the oil. So no demand means there's no business around the world. So when I have no business around the world, things go bad. That's the canary in the coal mine. It died. The Shanghai index dropped 30% in 3 weeks. The Chinese are telling people, if you say anything about how bad it is, we'll arrest you. It's against the law to short the market. Anybody has 5% holding in any particular company, they're not allowed to sell. So when you have the government coming in with their central banks and coming in with direct purchases in the stock market, something is wrong. So what I'm saying to you is that it's best to be prudent. Now, in 2008, let me tell you, here in Phoenix, I'm headquartered in Phoenix. Prices dropped like a rock, but our rents did not. And we're in business. Most of my clients are business people. We need income. So when their businesses are impacted, we need cash flow. So my clients We just kind of rolled right along. Certainly in my household, because we own cash flowing properties. Now we lost, some of the income came down. We lost about 15% of the rent totally because we were in turmoil. But 15 is a lot different than 70 or 80% on the purchases. We know people that had non-performing loans and just lost everything. In 2006, if you were one of my clients, you'd have been called personally by me telling you to move out. Most of my clients are already out of marginal properties. We moved out of marginal. We've made that call last year to move out of marginal properties. We're just into long-term holding properties. So we're sitting in a lot of cash because I do think that we're going to have a really good buying opportunity. Matter of fact, not a buying opportunity. I think we're going to have the greatest buying opportunity in the bull market of my lifetime is coming in the next 5 years. Now, in the next 18 to 24 months, I think you're going to have some really tough times. So I'm going to suggest to you to take this money that you take out of stock market, take 35 or 40% of it, and immediately put it into income-producing real estate. Now, your prices are going to drop. So if you have a $200,000 property and it goes to $150,000, you have to say, I'm a farmer. I own the land. I'm going to give it to the next generation and a generation after that. So I really don't care how much the land that goes up and down in value. What we're concerned about is the crop. All we're interested in is how much does this piece of property produce for us for income, because that income that we get is going to be a lifeline to you. So today, if you took $1 million out of the stock market, we'd be able to get you an income probably $40,000, $50,000, $60,000 immediately. But unlike a fixed income, let's talk about a fixed income. Let's say you were in high yield and you didn't care anything that a lot of these high yield was sold to the drillers in the Bakken Reserve, and it is at risk. So you're getting 4.5% off this. So about the same as what I'm getting. We're getting 4.5%. In 5 years, what's that bond portfolio worth? Still $45,000. $1 million is going to be $45,000. Mine, 5 years, we're going to grow that. So we're going to add 3% to that. So by the time $45,000, you're going to be getting probably $55,000, $60,000. So that's the difference. And our properties are in a completely different cycle. I don't expect this cycle to until the mid-2020s. So I think we're just fine, but we will go through a correction. So here's why I say to put some money in now, is because now you can get a 4% or 4.5%, fours, 30-year fixed rate mortgage on a property. Now, these are at historical lows. When they say historical, they mean they're probably not going down. So do you really think that this 4.5 is going to be 4.5% in 5 years? See, I think they're going to be probably 6 or 7. That impacts cash flow, makes for a huge, enormous difference. So I'm telling you right now, the corporations of the world are going out and getting bonds. You see this all the time. They're into the bond market, taking these long-term bonds. You should be doing the same. You should become a borrower now, not a lender, a borrower. Go fill up the truck. Just back it up and fill it up with all these long-term mortgages that you can get your hands on. Get it in the fours. You probably won't see this again in your lifetime. So let's get it. But watch your loan to value. You need to make sure that you get cash flow. So don't take it up so much that you're not getting cash flow. I'm not concerned with what the percentage of the return is. I want to make sure that you have cash flow. Make sure that you cover for all contingencies in case the garbage disposal breaks, or we have to put on some new carpet or some paint it. So we need to make sure we've got enough money to do that. And that's easy. If you call me, we can go over and we'll just pencil out. That's really easy. We just want to make sure you get cash flow because we're going to grow the cash flow. And these properties we buy, we're going to keep for a long time. But I want you to have cash flow for the next next 18 to 24 months. And then when we get into you'll have your cash that you're still sitting on, and we use that for opportunities of properties that come along that maybe we want to buy. Problem I'm looking down the line is if we get into an economic recession, doesn't necessarily mean that we have financing go along with it. So we want to get a nice core holdings that are going to be generating some income for you, because that is going to be really so terribly, terribly important. So a couple things let me just stress this again. You need to talk to your advisor and talk about an exit strategy. At what point do I start taking some of my money and reducing my risk in the marketplace? Now, a lot of these guys aren't going to want to do that. They're going to say, well, you need to hold for a long time because it impacts their income. And I don't mean to step on their toes. They're welcome to call me. But you've had huge profits. Sometimes you just need to ring the register. So take some of the profits off. It's an extremely compelling interest rate environment to get as much as you possibly can. So watch your loan to values, 50% loan to value, 60% loan to value. I don't think I'd go over 65% on anything. That adds to your leverage, and it adds to it enhances your return on a lot of properties. And then let's get some cash flow. We want to get cash flowing properties. We have lots and lots of opportunities in the marketplace. You should find a broker near you that will have some opportunities for you. A good broker is absolutely, positively worth his weight in gold. And if he's a fiduciary to you and is going to watch out for you, pay him. He's going to make money for you. So if you can't find something, you haven't got anybody, you can always call us. One of us will find something for you. If you send me $1 million, it takes me a while to place it. We always place it. There's generally good opportunities around. So I'll be here all summer. We have people working for me that will certainly be able to help you. But I am here all summer, so you're welcome to call me. So please talk to your significant other, talk to your advisor. Let's get an exit strategy for you, and then let's put our heads together and see if there is in some way we can get you a nice cash flow going for yourself. So my very best to you at always. Bye bye now.